Let's talk a little bit more with Michael Zinn. He's the managing director at UBS. And Michael, what we heard from Tepper was a pretty straight and easy analogy. He said when central banks around the world are tightening, it's going to be much more difficult for equities to go up. He's shorting the bond market, too, because he thinks they're telling you rates are going higher and he believes them. What do you think?
I'm not far off from that view. I mean, I think the market is underpricing a hawkish Fed. You know, the Fed is clearly telling you to, be wary of, persistent inflation, and they're offering 4.6% rates on 6-month T-bills. So even if you think this is a worthy debate, you're being paid pretty well to stay on the sidelines and watch the action unfold. So we think short-term bonds, 4 or 5% coupons and various investment grade T-bills make a lot of sense. We are positioned a little bit underweight on equities, a little more defensively. And I think, I don't know, it doesn't sound like the Santa Claus rally has been talked a lot about this morning, understandably. But I would also point out, when you look at the levels of the current VIX, which is around 20, which is near the lows of the year, that has generally coincided with peaks in the S&P this year. And you fast forward the calendar to next year, January 6th, we have the jobs data. January 12th, we have the CPI data. Then we roll into earnings and concerns about the earnings recession. And so I think there's a good chance the market's underpricing risk a little bit. And the good news, I think, for investors is if you have uncertainty, you can enjoy, great rates in money markets and T-bills and corporate bonds. And, you can still be assured of a decent return. And the last thing I would say is, look, if we do achieve a soft landing in the economy, that's awesome. And markets probably have bottomed if that's the case. But as we're seeing from earnings reports this morning, the market probably hasn't quite really priced in the likelihood of a harder landing, the likelihood of an earnings recession. So staying a little more defensive, a little more on the sidelines makes a lot of sense to us. Just take what the market's giving you.
What kind of a drop would you need to see in equities markets before you thought, OK, this is a better price point, this is where I would get back in?
Yeah, I think I would take my signal, from the Fed and what their tone seems to be, because in order to evaluate whether a market has bottomed, you really need to see selling exhaustion and the basis of the beginnings of an uptrend. And so the way we're thinking about it is that the Federal Reserve probably needs to see 4 good months of CPI and job prints before they even begin to hint at any kind of dovish tilt. So that brings us to the March meeting. So we're going to be a little careful before then, and we'll get a lot of information, over the next month. We'll get the earnings reports beginning to come in on the 13th or so of January. That'll give us a lot more info. So it's not a price level to me per se, Becky. It's more a market expression and what's going on at the time relative to the information.